What if I told you that you might be giving the IRS way more money than you need to? Well, you probably know that, but look, every year people overpay thousands just because they don't know 4 simple strategies. Today, I'm going to give you 4 tax-saving strategies that put real money back in your pocket. No loopholes, no gray areas, no need to study complicated tax law. Look, crazy enough, most people miss out on these savings just because they don't realize how easy it is. It's not about avoiding taxes. It's about planning ahead. Think of tax planning like preparing for a big game.
My last Super Bowl I was a part of, I was 2 weeks of watching film. I knew Kansas City's defense better than they knew themselves.
If you wait until the last minute, you're probably going to lose. But if you put the right strategies in place, you can legally save thousands of dollars. Taxes are one of the biggest expenses in your life and my life. Yet most people barely think about them until April. That's like showing up to a game with no game plan. You're already losing before it starts. I'm not only going to just break down the basics of these strategies in simple terms, but I'm also going to give you real examples of how people save thousands every year. Whether you're a high-income earner, a small business owner, or just someone looking to be smarter with their money, this video is for you. Let's get to it. One of the biggest misconceptions about taxes is that you need to itemize to save money. Most taxpayers, about 87% of Americans, take the standard deduction. That means unless your itemized deductions, like your mortgage interest, state taxes, charitable donations, add up to more than the standard deduction, well, then you're going to take the standard deduction like 87% of Americans. You might think there's probably nothing else that you can do. That's not true. One of the best ways and easiest ways for you to lower your taxable income is to simply use tax-deferred accounts. This is where most people leave just way too much money on the table. Let's say you make $200,000 of annualized income. You're a single filer. That puts you in the 32% federal tax bracket. Without tax planning, you could be paying a huge chunk of your income to taxes. Here's how a tax-deferred account can benefit you. Try maxing out your 401k. If you make that much money, you should be saving 15% of your income anyway, but you can contribute in 2025 $23,500 into your 401k. Your taxable income then goes from $200,000 down to $176,500 back into the 24% tax bracket. Then you could turn on an HSA account. You can put back in an HSA $4,300 for individuals. That means your taxable income is now down to $172,200 by only putting money in your pocket. You see, tax-deferred accounts, they reduce your taxable income, and in this situation, we reduce your taxable income by $27,800, which, by the way, just saved you $6,720. Look, most people focus way too much on deductions, when the real key to tax saving is reducing taxable income from the start. No itemizing required, no expenses. Just simply find a solution to reduce your top line income. Deferred accounts are one of the easiest ways for most Americans to do that. Next up, what we're going to talk about is tax loss harvesting. Look, if you're an investor, here's a simple strategy that can help you keep more of your gains and pay less in taxes without making a drastic change in your portfolio at all. Let's say you had a solid year in the market. Your portfolio is up and you're sitting on, let's just say $25,000 in capital gains. Look, that's great, but the IRS is going to take their cut. So here's how capital gain taxes work. If you hold an asset for less than a year, your gains are taxed as ordinary income. For top income earners, that's up to 37%. If you hold for more than a year, you pay the long-term capital gain tax, which is 15% or 20%, depending on your income. If your taxable income is over $492,000 for single filers, $553,000 for joint, you're at the 20% capital gain rate along with a 3.8% net investment income tax on top of that. Translation, you're paying a lot in taxes and you don't want to hand over more money. That's 23% of your investment profits you're giving to the IRS. That's where tax loss harvesting comes in. Sell an investment that's down to simply realize a loss. You're going to book the loss, use the loss to offset your taxable gains, reducing how much you owe. If your losses exceed your gains, you can then deduct up to $3,000 again next year and every year of your ordinary income. Let me give you an example. Let's say you made $25,000 in capital gains this year. You also have a tech stock that's down $15,000 at the start of year 2025. You can then sell that stock, lock in, or book those losses. Your taxable gains instantly drop from $25,000 to $10,000. If you're in the 23.8% tax bracket, you just save $35.70 in taxes by making this strategic move. I can promise you in a year like 2025, you better be harvesting losses at the right time. The only thing you gotta be mindful of is the IRS wash, rule, sell. If you sell a stock, then you need to wait 30 days before investing back into that identical or similar security. Tax loss harvesting, look, it's a powerful tool, but it's even more beneficial for high income earners. If you're facing capital gains of 20% or higher, harvesting losses can literally help you save more in money and reinvest that money over time instead of giving it to the IRS. As an investment advisor, if you use an investment advisor that claims that they're going to harvest at the end of every year, then your advisor and your investment strategy is way outdated. We're in 2025. Technology is extremely efficient, and you should absolutely be harvesting continuously throughout the year. Direct indexing, buying investments in bulk, giving you the leverage and the capability to sell at the right time, book the losses, and continue to implement your tax strategy throughout the year. That's how you tax loss harvest. Let's move to another high impact tax strategy. Charitable giving as a strategic tax move. Your call to give should be the priority. But if you have time to plan, consider this. What if I told you that you could support the causes you care about and significantly reduce your tax bill at the same time? That's the power of strategic charitable giving. Most people, they're missing out on tax savings because they're not structuring their donation strategically. If you take the standard deduction, which once again 87% of Americans do, your charitable donations don't directly reduce your taxable income. You're still having to pay the government the same amount. And if you want to deduct your charitable donations, you have to itemize. And to make it work, your total itemized deductions, including charitable giving, must be greater than the standard deduction. Most people's deductions, including the mortgage interest and the state taxes and the giving, it just simply is not above those limits. But here's the good news. There are ways to fix this and make sure that your generosity also benefits your bottom line, giving you the capability to give more. Look, instead of just writing a check, there are 3 ways I would say you should consider giving charitably while reducing your tax burden. Number 1, bunching donations for maximum tax benefit. Look, instead of giving small amounts every year, consider bundling several years together. Or if you are prepared to give at the end of the year and you're not going to go above that standard deduction limit, roll it into January and give it one time. This helps push your deductions over the standard deduction threshold, allowing you to itemize high donation years and take the standard deduction. Let's say you normally donate $5,000 or $10,000 a year, but your other deductions don't push you past the standard limit. Instead, wait from December and donate twice in January, because this might be the amount that you need to begin to use those donations as a way of also reducing your tax bill. Number 2, donor advised funds. This allows you the flexibility of giving. If you don't want to donate and distribute funds right now, a donor advised fund can help you get the deduction immediately in the year you contribute, but then distribute the money to charities over time. This is a useful tool for high income years or big bonus years. You sell a piece of property, you have a tremendous year in sales. It's that year you may want to consider a donor advised fund. Number 3, donating appreciated stock over cash. Look, instead of donating cash, consider donating stocks or assets that have increased in value. You avoid paying capital gain tax on the appreciation. Nobody has to pay the tax. You still get a full deduction for the fair market value of the donation. Let's say that you own a stock worth $10,000, but you only paid $4,000 for it. If you sell it, you owe capital gain tax on $6,000. Instead, if you donate the stock directly to a charity or a donor advised fund, you get a $10,000 tax deduction and avoid paying capital gain tax altogether. If you're already giving to charity, structuring your donations the right way can make a massive difference in how much money stays in your pocket while still supporting the causes you care about. There's so many ways that you can still be generous while also reducing the money that otherwise would have went to the IRS. We gotta think, we gotta play the game. So far, we've talked about ways to reduce your tax bill today. But what about the future? Let's talk about one of the most powerful long-term tax strategies, a move that could literally save you hundreds of thousands over your lifetime, but I'm not kidding, can save your family and the next generation millions. That's where Roth conversions come in. Look, this strategy doesn't lower your taxes right now, but it can save you a significant amount in retirement and for your estate. If you have money in your traditional 401k or your IRA, you might think you're set for retirement, but there's something that most people forget about and they don't realize. You're still gonna owe taxes on that money when you withdraw it. Whether you like it or not, 30 to 40% of your IRA and your 401k is not even yours. Because contributing to an IRA and a 401k is tax deferred, that just simply means you haven't paid taxes on it yet, but you will. Once you retire, those withdrawals are taxed as ordinary income. And if the tax rates go up, you could be paying a lot more in taxes than you expect. After age 73, the IRS is going to force you to take distributions, required minimum distributions. These distributions not only increase your tax liability, potentially increase your tax bracket, it also creates taxation on Social Security and increases your cost of health care. Do you think taxes are going to go up in the future? Potentially, maybe. A Roth conversion is something that allows you the flexibility and the freedom to pay the tax when you think it's the right time. You're simply moving money from IRA or 401k to Roth. The reality and the catch, you pay the taxes today, but you're paying the tax when you know it's best to pay the tax. And then your money grows and compounds tax-free for the rest of your life. There's not even an inheritance rule that requires them to pay taxes when they get it. It's tax-free growth for you and the next generation. It protects you against future tax hikes. Like if taxes go up in the future, you've already paid the tax today. There's benefit in knowing what you know today versus the uncertainty and the unpredictability of the future. Paying taxes may not be the worst thing to do. If you leave it there, you could pay 22 to 32% in taxes in retirement. But check this example out. What if you took $50,000 and you converted it over several years by only paying 12 to 22% because of your ordinary income today? Then that money grows tax-free and tax-deferred. And in retirement, it's going to be 100% tax-free when you take it out. Over time, a strategy like this, depending on how much you convert and what the cost is of future taxation, it can be wildly beneficial. For many of our clients with large retirement accounts, this is exactly what we're doing every single year in our tax strategy, is ensuring that our clients pay taxes at the right time. And done correctly and consistently, I can guarantee that our clients won't have to file a tax return for the rest of their life. They won't have to pay taxes on Social Security for the rest of their life, and they're not going to have to pay increased cost for health care because we're doing the right thing today based off what we know about today and what we see in their future relative to tax laws now. You got to play the game and you got to play it wisely. The biggest mistake that most people make is they just simply do nothing. But these are just simple strategies that all of you guys can use. You just have to plan ahead. We want you to optimize your tax plan to benefit your situation today so that you can live later like nobody else can. But you have to think through what you're going to do and how you're going to execute. If you need help, we want you to feel totally comfortable to reaching out. Asset Management Group and Beyond Tomorrow, we're here to serve you and to ensure that your decisions are made correctly for your future. Take care.